We are at war right now, not on the battlefield, not just in headlines, not like Iranian war, but I'm talking about a financial war. And in my view, it is ordinary investors against the biggest players in the system, the major banks, giant asset managers, and the institutions that always seem to know what is coming before everyone else does. The market is breaking down right now. Stocks have hit multi-month lows. Gold and silver dropped hard, although for now, that selling seems to be slowing. But zoom out, and the damage is massive. Trillions of dollars in value have already been wiped out in a very short period of time. And what are the big banks telling the public? Buy the dip. Stay the course. Keep investing. Do not panic. But here is the real question. Are they following that same advice with their own money? Because history says no. And today, I want to walk you through the difference between three very different stories. What the banks tell retail investors, what they tell their institutional clients, and what they appear to be doing themselves. Those are not the same story. And when those three stories stop matching, that is when you need to pay attention. This is Bridgeport Finance Channel. Before we go any further, I am not a financial advisor. This is not a recommendation to buy or sell any asset, and you should never make financial decisions based only on what a random person says here on YouTube without consulting the professionals in the field. Do your own research. Talk to a licensed professional. Think for yourself. Now, with that said, let me tell you why I am so concerned. Because I have seen this movie before. I saw versions of it in 2001. I saw it in 2008. I saw it again in later market shocks. And the pattern is always the same. First, they tell the public everything is fine. Then, behind the scenes, they position for trouble. Then the floor gives way. And by the time regular investors realize what happened, the damage is already done. If you want to understand why I think that matters today, go back to 2007. At the time, Goldman Sachs launched a massive structured product tied to subprime mortgages. It was packaged and sold as a high-yield investment. On the surface, it looked sophisticated. It looked safe enough. It looked like something smart money would buy. But internally, the tone was very different. One of the most famous lines from that period came from inside Goldman itself, when a senior executive described the Timberwolf deal as, quote, one shitty deal. Think about that for a second. A product was being sold to clients as a serious investment opportunity, while internally it was being described in terms that made clear they knew it was deeply flawed. And the consequences were brutal. Investors bought in. Losses came fast. Funds were crushed. The product itself collapsed in value. And while clients were being told to stay calm, Goldman had reportedly built a huge short position against the very mortgage market tied to those products. That is the part you need to remember. Publicly, reassurance. Privately, protection. Internally, profit from the collapse. That sequence matters because, in my opinion, we are seeing echoes of that same behavior right now. The current market damage is not random. It is building into something larger. The market has just gone through one of its worst losing stretches in years. Major indexes have been hit hard. Huge amounts of equity value have disappeared in a matter of days. Some of the biggest technology names in the world, the so-called untouchable giants, have lost staggering amounts of market capitalization. And this is exactly why I have warned for a long time about blind faith in the biggest stocks. The Magnificent Seven were treated like they could only go higher. People were told they were safe. People were told to buy every dip. People were told these companies were too strong, too dominant, too essential to fail. But no stock is untouchable in a macro shock. Nothing is untouchable when liquidity tightens, debt costs rise, and fear takes over. And now we have a trigger powerful enough to pressure the entire system. The oil shock tied to the Iran crisis. Crude oil has surged. Energy markets are under pressure. Supply fears are everywhere. And this is not the kind of problem that disappears with a simple central bank rate cut. This is a structural shock. That means it moves through everything. Transport costs, food costs, manufacturing costs, consumer prices, business margins, household budgets. And once that process starts, it becomes much harder to control. But here's the part that makes this even more dangerous. The market now seems to be influencing policy in real time. There is a framework created by Deutsche Bank's cross-asset strategy team called the Trump Pressure Index. It tracks a mix of approval ratings, the S&P 500, treasury yields, and inflation expectations. In simple terms, It tries to measure how much political pressure is being created by financial pain. And right now, that pressure appears to be intense. Wall Street is effectively trying to estimate the exact level of market stress that could force policy reversals. In other words, traders are watching markets not just to predict prices, but to predict political reactions. That is a dangerous place to be, because when markets begin dictating policy, confidence becomes fragile very quickly, and the current paradox is extraordinary. The United States is in active conflict with Iran, yet at the same time, policy decisions have reportedly been adjusted to keep oil flowing into the global system. Restrictions on some energy flows have been eased. Russian oil flows have also been treated with more flexibility in certain cases. Think about what that says. It suggests the system is under such severe pressure that policymakers are willing to make extraordinary exceptions just to prevent an even deeper shock. And if that is true, then we are looking at a very serious stress event, because oil is only one piece of the puzzle. Fertilizer matters too. Natural gas matters. Industrial metals matter. Helium matters. Shipping routes matter. When global choke points break down, you do not just get higher fuel prices. You get ripple effects across agriculture, manufacturing, infrastructure, and technology. This is how inflation can come back fast. This is how growth slows at the same time. This is how stagflation becomes a real fear. Now here is where things get even more important. What is the public being told? Stay calm. Do not look at your 401k. Keep buying quality stocks. Avoid trying to time the market. That is the public message. And to be clear, sometimes that message is reasonable in a long-term investing framework. Panic selling at the bottom can destroy people. But the issue is not just what they are saying. The issue is whether they are saying something very different behind closed doors. Because according to what I am seeing, that is exactly what is happening. BlackRock has reportedly shifted its stance on U.S. equities, moving from overweight to neutral. Their internal view appears to be moving away from the soft landing story and toward a more difficult reality that includes slower growth and persistent inflation pressure. That is a major change. Goldman Sachs has been raising recession concerns. JP Morgan has been increasing the odds it assigns to an economic downer. Growth forecasts have been cut. Credit quality concerns are back in focus. And the tone around risk is getting darker. So let me say this clearly. Public message, stay invested. Institutional message, risk is rising. Internal positioning, prepare for damage. That gap is the whole story. And it gets even more serious when you look at the tools being created. Because in 2007, the key signal was not just the public statements. It was the hidden positioning. And today, banks are once again creating products that make it easier for sophisticated money to bet against the very areas that retail investors are still being encouraged to buy. JP Morgan has launched credit default swap exposure tied to major AI-related hyperscalers. In simple English, that means large institutions now have another way to bet against the credit quality of some of the biggest companies driving the AI boom. And that matters because these companies are borrowing huge amounts of money to fund infrastructure, data centers, and expansion. AI may be revolutionary. It may change the world, but that does not mean every balance sheet tied to AI is healthy. It does not mean all debt issued in the name of AI will be safe. And it definitely does not mean retail investors should blindly buy whatever has an AI label attached to it. This is the part many people miss. A good story does not always make a good investment. A powerful trend does not erase valuation risk. And debt-fueled growth becomes dangerous when capital gets more expensive. At the same time, there are signs that other short-side structures are being built around vulnerable sectors, including parts of finance and private credit. Private credit, in particular, has become one of the biggest bubbles people worry about. It grew quietly, then quickly, then massively. And now the question is simple. What happens when defaults rise, liquidity shrinks, and everyone who thought those assets were stable suddenly wants out? That is not a small question. That is a trillion-dollar question. And while all of that is happening, what are the biggest players buying for themselves? Hard assets, physical gold, physical silver, things with no counterparty risk, things you can hold, things that historically protect value when trust in the financial system starts to weaken. That is why I keep watching the precious metals market so closely. Because when institutions tell the public one thing and quietly accumulate hard assets for themselves, I pay attention. Now the big question becomes, what do you actually do about all of this? How do you survive a system that seems designed to protect insiders first? Here is my personal playbook. Again, this is not financial advice. This is just how I think about survival in a market like this. Rule number 1, avoid leverage. This is one of the most important things I can say. Years ago, retail traders had more room to operate with leverage and still survive. Today, the edge is much smaller. The market is more automated, more aggressive, and more efficient at punishing weak hands. Banks, hedge funds, algorithmic systems, and now AI-driven trading tools can push volatility around in ways that wipe people out fast. Leverage turns a bad decision into a disaster. And in a panic, leverage does not forgive mistakes. One wrong move, one violent swing, one forced liquidation. That is all it takes. So if you want to survive this kind of environment, staying away from leverage is one of the cleanest forms of protection. Rule number 2, focus on survival, not maximum profit. This is where many people get trapped. During easy markets, people think in terms of upside. During hard markets, you need to think in terms of endurance. Your first job in a crisis is not to get rich. Your first job is to make sure you are still standing when the crisis ends. Think of it like a storm shelter. When the storm hits, you do not stand outside trying to prove how brave you are. You get somewhere safe. You protect what matters. You wait out the worst of it. And when the sky clears, then you rebuild. Financial survival works the same way. That means focusing on areas that historically hold up better during recessions or high-stress periods. Consumer staples, basic energy needs, essential goods. In some cases, forms of low-cost entertainment that people still turn to when times are hard. These sectors are not exciting. That is the point. Boring can be beautiful in a crisis. And of course, hard assets also matter. Gold and silver have historically served as protection against currency debasement, financial stress, and loss of confidence in institutions. Rule number 3, be patient. Do not let panic force you into rushed decisions. Do not feel pressured to buy because someone on TV said the bottom is in. Do not feel pressured to sell because social media is full of fear. Slow down. Study what is happening. Talk to qualified professionals. Build your understanding. Then act with intention. Patience is a position too. And in a market like this, patience can save you from a lot of pain. Let me leave you with this. What destroys ordinary investors is not just the crash itself. It is the mismatch between the story they are sold and the reality that insiders are preparing for. That is the real danger. When the public is told to hold risk, while institutions hedge risk and insiders build tools to profit from the collapse, you are no longer dealing with a fair game. You are dealing with a system where information, timing, and access are everything. So do not be passive. Do not be naive. And do not assume the public narrative is the full story. Question what you hear. Watch what they do. Protect your downside. And make survival the priority. Because if you survive the storm, you give yourself the chance to rebuild on the other side. And that, in the end, is how you win. Thank you for taking out your time to watching this. And if you have not subscribed to Bridgeport Finance channel, do so. Also like and share to anyone that needs to hear this. See you next.